Hi, welcome everybody. The topic for today's discussion is the much awaited Union Budget 2023. My name is Karishma Fatarfekar, and I have the pleasure of hosting today's interaction. As India guides through the Amrit Kal, the Union Budget 23-24 lays down a futuristic outlook of the Indian economy. In my view, really, the budget strikes a fine balance between prioritizing the spendings, fiscal prudence, and vowing to reach the fiscal deficit below 4.5% by 25-26. Also, by unleashing the capex bazooka, this budget is really a statement made to other economies of the world to look at India as the bright star for the emerging infrastructure projects and the startup ecosystem. So, to unfold the various nuances of the budget proposal, we have with us today our subject matter experts, Sir Sanjay Kumar, Sumit Singhania, and Gulzar Didwania. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are only on a listen only mode. If you have any content related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen if you want to download today's slides and related publications. Please go to the download and links box. On the other hand, mobile device users can view the slides and answer the survey on screen. And thirdly, if you require an attendance record for this event, you will receive an automated email with the CP certificate after watching for about 50 minutes. So now let me give you an overview of the topics that we will discuss today. In the next hour, we will have Sanjay sir express his expert view on the fiscal indicators and the path it lays out for India. We will then have Sumit cover the impact of the direct tax proposals, and then we'll wrap it up with Gulzar covering the impact of the indirect tax proposals. So over to you, Sanjay sir, to cover the fiscal indicator part.
So thanks, Karishma. In fact, you said it absolutely correctly that it was like investment bazooka, and that is something which was actually because the growth in the investment, that the higher allocation in investment is in line with what happened in the last few years, but certainly it is moving to a higher level. So the government, the way it had done it is definitely working on what it had done in the last few years on investment, on boosting the consumption, and trying to make sure that the export also remains as buoyant as ever. And good part is that the export there is 17% higher than the last year, and which the if I look at the long term average, that was about 13%. So this has been a really good path for a higher growth rate. The GDP for the current year, which is FY 22-23, has been at 7%, and what it has been estimated is a little longish, GDP, wider spectrum from 6% to 6.8%, with base level of about 6.5%. And I can understand why they gave a wider, the number between 6.6 to 6.8%, and that is because there are some uncertainties, largely because of the global slowdown. Uh, in the budget, they have largely used a nominal GDP growth rate of 10.5%. And in that, they have thought of inflation to be between 2 to 4.5%, which I think should happen because of certain things, fiscal deficit being low, and in general, things have started cooling off on the consumer items also. The budget outlay is about 45 trillion rupees, which is almost you know about 14.94% of the GDP, and this is slightly lower than the last year's budget outlay, which was about 17.2% of the GDP. So the GDP, the budgetary outlay has actually gone down as percentage of GDP, but the in nominal terms, it's up by uh, a big number, almost like 3 trillion rupees or 4 trillion rupees or so. Expenditure also, if we look at the spending mix between the revenue expenditure and capital expenditure, that has also started going down, which basically means that the capital expenditure has been going up, and that's something which Karishma, you spoke about, and that is something so heartening also. uh, One expenditure item which think needs a mention is subsidies. And subsidies as a budgetary outlay is down by 1%. But actually, if you see it in the nominal terms, the fertilizer subsidy is down by 22% from the what was the allocated last year. So now it is at about 1.75 trillion rupees. Uh, Food subsidy again down by 32%. So now it is again at 1.97 trillion. And petroleum subsidy, which is almost going down over a period of time, is further down by 34%, which is now at 22,570 million rupees. So subsidies are going down over a period of time. Tax revenue has been very buoyant, and while we will go further into the tax numbers, the going rate for the GST has been about 1.6 trillion per month, and in rupees terms. And the for the direct taxes, we expect that the overall collections will be higher by almost like 7% or 8% over the budgeted estimates. So this is the time when the tax numbers are going to go over. The fiscal deficit, though it has been contained at 6.4%, but then there is a glide path that the government is expecting. And for next year, they have put it at 5.9%. And over a period of time, and that is going to be in the next 2 years or so, they want to achieve 4.5% of GDP as the fiscal deficit. Can you move to the next slide, please? If I, the numbers on the screen will give you a good idea of how the direct taxes have been growing. And the one which is on the first deck, that is the direct taxes, the year-to-year growth in the of direct taxes has been about 10.3%. This is a good number, and it definitely gives a good buoyancy also. In But I think the government is intending to widen that and further deepen that, and the GST is actually helping us on that. And if you look at the second deck on the same screen, that also gives you a good idea of how the GST has been growing year to year. It's 12%, and uh, we believe that in the year to come and in the months to come, GST will pick up further, because as consumption grows, GST will pick up far more. Uh, this All these are putting India into a good zone, and that's the reason why they have been able to contain, apart from certain structuring that they are doing over on expenditure. They should be able to contain the fiscal deficit. We'll come to the fiscal deficit a little later also. Can we move to the next slide, please? This slide will give you a good idea of how the expenditure are taking place, and this is only for the central government, because even the state governments, India being a federal polity, the states also spend, and many of these expenditure, particularly health and education, are something which is the health. The state governments contribute a lot. Most of the delivery is done at the state level. Uh, one and if just talk about the numbers on the screen, the road expenditure, the expenditure on road is going up. The railways is again another area of development. And then the third one, which I would want to point out, is the urban development. And in that, the two items are of special interest. One is the metro projects. Many cities in India are having either they have started the metro projects or they're expanding the metro projects to every nook and corner, and also connecting with the nearby cities if the city itself is becoming a big one. Uh, Another thing which I would want to mention, which is the IT and telecom, and that is which will cover the digital infrastructure development. And something which I would want to mention here is that the digital infrastructure has been growing every now and then, and uh, the COVID, vaccination that was done through the COVID app, and many other things are being delivered digitally. And so India has moved on to a very firm path on digitization of the services, and that is something very important for a country as big as us, and uh, also with a population touching almost like 140 million. So let me move to the next one. The slide on this tells you how the where does the most of the rupee come from and where it gets spent. One of the large payments, as one can see on the right hand side of the screen, is on for the interest payment. Then the government also gives a lot of shares of their tax revenue to the state, and that goes as an expenditure, which is about 17%. Uh, and that is part of the federal structure that we have, and that is done by a 5 yearly body, a constitutional body called Finance Commission, which sets up something like this and decides on how much money should be allocated from the central funds to the state funds. Apart from that, there are other transfers which is about 10%. What has not made any change is the pension and defense, and both are remaining where they are. And I have already spoke about the subsidies, because the subsidies from last year to this year has actually gone down. Coming to the revenue, the borrowings are down for the budget outlay from 35% last year to 34%, which is a small correction, but nonetheless a very significant one. Corporate tax and income tax would continue to be at 15 and 15, that is 30% of the budgetary outlay. And the customs is, but actually, if you see on the tax to GDP ratio, the corporate tax have been going down, which basically means that from the economy, the lesser and lesser amount of corporate tax is being collected. Personal income tax continues to be at the same level, and the same is for the customs also. So, so this basically brings that there's a lot of space being created for the private investment and private entrepreneurship. Let me move to the next one. The fiscal deficit, the graph on the left side will give you a good idea of how the fiscal deficit is growing, and that's the number which is right at the top. And as you could see that it is growing down, but during the pandemic, it went up to almost like 9.2%. So from 9.2%, we moved to 6.7, then 6.4, and now we aim to have at about 5.9%. But before that was at about 4.5% or so. So in general, the government has managed the fisc very well, I must say, barring the 1 year when the pandemic was one of the biggest costs. And how that fiscal deficit is being financed is on the right side. And as you could see, that the large part of the fiscal deficit comes is uh, sourced from is bridged from the market borrowing, and short-term borrowing are also going down. Similarly, the provident fund is also it's a growing one, so we'll do that. And external debts, which were earlier very minimal, went up during the COVID period, quite high, and now it is being brought down subsequently. So that is all, Karishma, from my side.
Yes, thank you, sir. So I think one of the points you did mention about the reduction in subsidy, right? I think it could also be because of the fact that production link incentives were introduced and they actually work like a fiscal subsidy to push the Atmanirbhar project of the government. But yeah, of course, having said that, let's move to our polling question number one. And while everybody is answering the polling questions, sir, just a question for you that what are your thoughts in terms of the manufacturing push given the current geopolitical situation?
So, Karishma, you mentioned about the PLI. That is certainly one of the important one. If I have to say, the government did not really talk about the PLI, Make in India as a project, because that is one of the important areas of attention for government. But it did take number of actions to improve the manufacturing in India. And some of the key ones, as we see, is happening in the in the uh, through the for exports, etc. And that is something quite heartening. But another thing which I would want to mention, and that is MSME. MSME is the bulwark of manufacturing, and as in any country, so in our country. And now, and manufacturing really suffered, MSME really suffered during pandemic year. And now, as I was looking at the economic survey, it talks about that the credit offtake is about 30%, and there is a lot more formalization taking place of the MSME, which has been a problem. So, as I see it, the government is looking at the manufacturing push, and I do see that there is a where would this manufacturing go? One is, of course, going to be the domestically consumed, but the push is also for exports. On that, there will be headwinds, given that the global situation is not as nice. But it will at least the government would take some of those actions to improve the manufacturing sentiment, as well as for export sentiment. And I'm sure Gulzar will talk a lot about that when he presents.
Sure, thanks, sir. So I do get tempted to just make one comment that in addition to all the fiscal prudence, one big thing from a policy standpoint, as a woman, I feel that was called out was to enable 81 lakh women self-help groups to evolve, right? And upscale professionally managed organizations. So again, that's a push to a startup ecosystem for the women professionals. Positive note, let me call in Sumit to cover the direct tax proposals.
Thanks, Karishma. Next slide, please. I think if I was to tee off the direct tax segment for this webinar, I would say there's a good news to start with, which is to say the tax rate has not been largely tweaked at all. There was some anticipation that the services company could get a bit of tax break by having a percentage point reduction in the tax rate that they have, but that was not to be. So if you look at the status quo, effectively a manufacturing company which is set up after October 2019, they continue to be eligible for a 17% tax rate. If you choose as a company to not avail any tax incentives, then the headline tax rate remains 25.17%. The minimum alternate or the accounting tax does not apply even there. For the foreign company, there was a wider anticipation that the tax rate may be again rationalized a bit, but that's another miss in the budget, so to speak. So largely no change in the headline tax rate, no change in the surcharge and cess. Uh, Once again, there was an expectation widely that the capital gains tax regime should or need to be overhauled. I think the government has given it a miss for the year, maybe because there were a couple of other giveaways in the budget, and there was only so much of the wiggle room. So the capital gains tax rate remain where they are. The expectation on the capital gains tax regime rationalization has also not been fulfilled to some extent, but I guess there is a headroom there for the government to probably do it in the next budget or so. So that remains again a status quo. On this slide, if I were to just call out one disappointment for largely infrastructure company would be the government has actually not carried forward the benefit of the lower tax rate for the infrastructure long-term financing. Currently, the law allows a concessional rate of 5.46%, but that rate sunsets on June 2023. There was again an expectation that this will get carried forward for next 2 or 3 years because a significant amount of the close to $1.3 trillion of the long-term capex which is required for the infrastructure sector. Unfortunately, that has again been given a sort of overlook. What does this really mean for large infrastructure companies is that their cost of or the tax cost of the long-term borrowing could increase from 5.46% in some cases to 10, in other cases to 15. And in cases where the lenders are not having the tax treaty cover, it could go all the way to 20%. So there's significant tax cost increase which happens, and that will require rethinking of some of the long-term debt strategy, swapping between the different instrument of the long-term borrowings. Next slide, please. If you look at some of the detailed provisions of the finance bill, there are some rationalization given to the small businesses and small professionals. The presumptive taxation, which was already the law, the overall threshold has been increased by 50% for the businesses. You can claim the presumptive taxation if the total turnover is up to 30 million. For professionals, that has been increased from 5 million to 7.5 million. So that's to me that's like a marginal relief for some small businesses and small professional service providers. One important change which happens in terms of the taxability of perquisites or business perquisites, there was a law introduced in last year's budget and now fairly popular law 194R, which seeks to tax all sorts of benefits and the perquisites which are otherwise not taxed in the provision of the law. There was this debate around whether if it's a cash perquisite or cash benefit, does that still be subject to or does that have to be subject to tax? The budget now clarifies that even the cash perquisite will get covered in the ambit of the tax withholding provision and the taxability. To me, that's like a clarificatory because there was always this overhang of this being covered in the overarching provision of Section 194R, but that clearly sets aside all the controversy which were ensuing in last 10-12 months on this topic. Next one on the intangible assets, it's a clarificatory law. There was already a provision in the law that self-generated goodwill, the cost of acquisition of that asset was to be considered as nil, and therefore at the time of the sale, the capital gains were to be paid. the taxpayer used to take a position with respect to the other intangible assets to say that if it's a self-generated asset, then the cost of acquisition is indeterminate, and therefore the computation provision actually fails to that extent. That anomaly has been set right now by saying even for the non-goodwill, other intangible, the cost of purchase will be considered as nil, and accordingly the capital gains provision would need to be applied. For FPI, there is a bit of there's a bit of change here, which is not a positive change. For a particular hybrid instrument, which is called market-linked debenture, where if essentially the interest or the return is linked to the market indices and the underlying securities. Historically, the law said this was to be given as the same treatment as the capital asset, and as long as you held it for more than 12 months, the tax rate will be 10%, like a long-term capital gains tax. But now this budget proposes this to classify this particular type of hybrid instrument as a short-term capital asset, and the rate of tax on the sale effectively increases from 10% to 20% in case of FPIs, and in case of non-FPI goes all the way to maximum marginal rate, which could be 30% plus. On the thin cap rules, a very, I would say, positive change, because there has been this demand from the industry that just like banks and the insurance companies are excluded from the applicability of thin cap rules, the NBFC should also be excluded. So I think it's a welcome change. What is missing here still is the pure holding companies are not excluded from applicability of thin capitalization rule, which continues to be a problem for the tiered holding structure, where pure holding company may not have any kind of a EBITDA or operating income to offset a significant amount of the interest cost. So one part done, which is NBFCs are now excluded, but the pure holding companies are yet not excluded. Next slide, on some of the important changes. If you look at I'm going to call out the one in the middle column, which is on taxation of the share premium. There was this law introduced in 2014 or 2012 Finance Act, which was to tax the premium received by an Indian company from the resident shareholder. And the logic that was explained in the memorandum to the finance bill was to say that in cases where the unaccounted money was being funneled into the private limited companies or companies which are not publicly held, there was a need to tax that income, unaccounted income. But now in this budget, that realm of that provision has been extended to cover all sorts of investor, all private equity, venture capital. In fact, all FDI categories of investor will also get covered. Now, to our mind, this is really a far-reaching provision, definitely a concerning change in the law. It could mean as simple as that any FDI transaction will need to be at the DCF or at the fair value. The moment the investment threshold increases beyond the fair value, there is a tax to be paid, and the tax rate is as high as 25%. So this could have like I said, far-reaching impact on the FDI flows in India. But if one looks at the rationale given in the memorandum, it still does not sit very well with the rationale given for the original introduction of the law itself. In cases of the foreign money coming into India, the issue of unaccounted wealth is to be addressed in a selective manner. This kind of a sweeping change in the law that could impact overall flow of the FDI. So I would call out this provision where there is a likely review possible before the budget gets approved by the parliament. There should be representation made, and there will be representation made, and hopefully government will try and relook at the language. If they have to cover a specific class of investment, that can be sort of provided for, but this sweeping law will need to be definitely relooked at. If you look at for the startup, the overall theme of the budget is to promote startup investments again, and in line with that spirit, two important change that has been done for startups is one, the overall period within which the provision of the carry forward of loss will not trigger or will trigger has been extended from 7 to 10 years, and that's again a welcome change, because it allows startup a slightly bigger runway to get the new investor able to flip their shareholding structure without losing an important tax loss asset on the balance sheet. So overall, accretive to their valuation and the plan to get the investors in. And also the tax holiday period, the cutoff has been extended by 1 more year, which means startup getting incorporated till 31st March 2024 will get the tax holiday. That's again a net positive, so to speak. A change on the tax loss carry forward provision, fairly limited in its reach and targeted for some strategic disinvestment that the government will carry out. In fact, the finance minister called out this was for IDBI, so I don't think it's going to impact private mergers and private divestments, but largely meant for a particular class of the asset divestment. Next slide, please. A couple of rationalization in the provision for SEZ, special economic zone. Now the law provides that for special economic zone units to claim tax holiday, they need to claim or sort of realize the export proceeds within 6 months. Now that could be a significant requirement for units which have not been doing the treasury management perfectly, especially for the captive units. This was 6 months will be quite a bit of task to fulfill, but that becomes a key criteria for tax holiday continuity. And of course, the tax return needs to be filed within the due date. That's a procedural change. It requires some bit of more work to be done, but realization of export proceeds within 6 months is something that units will need to watch out for. For MSMEs, once again, it's in the interest of promoting MSMEs' capital flows and their working capital management. Any taxpayer paying paying money to MSME, they will be able to claim deduction only if they pay within the specified 15 days or 45 days. A delayed payment would obviously be linked to the disallowance of expenditure. I think this provision is essentially meant to allow MSMEs to benefit from cash flow management requirement. Next slide, please. Some of the administrative provision in the law on the tax refund process, practically it was already happening that tax authorities would adjust the outstanding refund against the tax demand pending in the proceeding, which is yet to be concluded, but I guess that gets formalized now. It just gives more teeth to the tax officer to keep withholding the tax refund. Like I said, it was already happening. It just becomes more formalized in many cases now. A big positive is in the spirit to sort of try and liquidate many pending litigation. The government is now proposing a new forum alternate to the commissioner appeals. And we heard the budget speech, the finance minister saying they will deploy close to 100 joint commissioner to sort of man this new forum. Hopefully, this will unlock a significant amount of the dispute clogging that happens currently at the first level of the appellate authorities. And if that happens, then the cascading effect of this is that the number of dispute clogged at the ITAT and the High Court level will also get undone to some extent. So overall a positive administrative change in the interest of bringing the ease of compliance and ease of doing business in India. Time limits to filing tax return in some cases of the reassessments have been rationalized. Usually, or in practice so far, this timeline used to be more practical given by the tax authorities. In some cases, it will be as low as 1 month or 15 days. Basically the budget says there will be a statutory timeline of 3 months for filing the tax notice for the tax return, and in cases where the return is not filed within this timeline or filed after timelines, then officer will have the ability to start the reassessment without going through the normal routine procedure of issuing scrutiny notices. So that's again, it just puts the taxpayer slightly bit of more on toes, making sure that they comply with the notices in time to be able to take this forward. Next slide, please. On transfer pricing, no substantive changes, if I may say so. On the procedural aspect, the overall timeline to submit the required information, transfer pricing report and documentation have been reduced from 30 days to 10 days, which is extendable by another 30 days. Not substantive, and ideally it should not be such a huge issue for taxpayer in many cases because the documents are anyway to be prepared in advance. So this is at best a procedural change. The scope of domestic transfer pricing has been expanded, and again, I wouldn't call it a new change because it was already the law for manufacturing company claiming 17% tax rate. Now that the cooperatives have also been allowed to claim 17% tax rate, the provision have been aligned to say those cooperative will come within the realm of domestic transfer pricing provision, which is a fair ask if you look from a legal standpoint. Uh, the last point is linked to what I was saying earlier on the section 5627B. The proposal itself to cover all sorts of investor, all sorts of investment where the investment is happening at the premium, and then bringing this to tax. That is in itself a concerning amendment, as I said, linked to the transfer pricing. There was a decision in the past from the Bombay High Court in the Shell and the Vodafone case, and thereafter there was an administrative circular issued by CBDT where the government actually accepted the position that issuance of a fresh capital is a capital account transaction, and there was no reason for the Income Tax Act to bring that premium on capital to tax because it was a capital account transaction, not a revenue transaction. Now, to me, it seems like it's a clawing back of that position in some sense. It's like a backdoor to tax that share premium, which in a very stated way has been called out to be capital account transaction. Now, if that happens, then clearly the taxpayer cannot rely on the Bombay High Court decision to say transfer pricing provisions do not apply because now that income itself or the flow of capital has been made subject to tax. So transfer pricing provision will need to be complied with. Depends on whether or not 5627B amendment itself goes through finally or not. But if it does go through in the final act, then transfer pricing becomes an added compliance for those taxpayers. Next slide, please. Some of the other rationalizing provision, a good change for sovereign wealth fund and foreign pension funds. We all know that there is a tax exemption available to sovereign wealth fund and foreign pension funds, but there was this administrative problem that despite having a notified tax exemption from CBDT, in some cases withholding would still apply if payment was made by a InvIT or by a SPV to sovereign wealth fund at a 5%. Now those funds have been allowed the ability to go to the tax authorities and seek a lower withholding order, and this is something that we have been looking forward to. In some cases, representations were made, so it's a good outcome against those representations. TCS on the foreign remittances, it was already in the law at 5%. You'll find a bit of difficulty in finding the logic moving 5% tax rate to 20%. To some extent, it would be an absurd increase in the tax collection. Ultimately, it's not a tax cost. It just puts the cash flow management a little more difficult for especially individual taxpayers, sort of making it fourfold tax collection. So that's a bit of challenge, but not something that's going to impact the corporate taxpayer largely speaking. On the REITs and InvIT, again, a rationalization of the provision. There was a situation in the existing construct where if the REITs was to distribute surplus capital to the unit holder by way of redemption of the unit or otherwise, those redemption was not being taxed. Now the law has been in some sense expanded to say that any sum which is distributed by REITs and InvIT to unit holder other than dividend or interest or rental income, that sum would be considered as taxable income for the unit holder. And if it is not accompanied by the redemption of the unit holder, then whole of that amount gets subject to tax. In cases where there is a redemption of the units, then the cost of the unit gets deducted from the amount which is subject to tax. So effectively, it sort of closes a loophole where the surplus being distributed by REITs other than in the form of dividend or interest was not getting taxed. Now that amount is being brought to tax clearly. So that's the change which this law will bring about. The last point really for me to say is on the specific winnings, gaming income, the tax rate has been aligned to speculative incomes. So all the gaming winnings and gaming income will be subject to 30%. With the proliferation of online digital gaming, this law was coming. It was hiding somewhere. So I think it is not going to be a good news for many of your youngsters who obviously make more gaming income than they make the routine income. So this is going to be a tough one to deal with for individual taxpayers particularly. I think coming to the end of my presentation, maybe next slide quickly. As far as the individual tax or personal income tax is concerned, marginal benefits have been given to low income taxpayer. In summary, what has been done is the tax slabs have been tweaked a little bit. The overall impact of this is that each individual taxpayer may get marginal relief on their income bracket as far as the total tax outgo is concerned. The headline here is that for taxpayer who are making less than roughly $9,000 a year, they do not pay tax. The limit earlier was $6,000, so there is this benefit given to the individual taxpayer who were paying taxes, but in the marginal category, they have been exempted now. Karishma, I think that's the last slide I have. We can straight away move to the polling question then.
Thanks, Sumit. So while the polling question is being answered, just a quick question to you, Sumit. The budget, as you said, has expanded the applicability of the anti-abuse fair value test, right, to all the types of investors in common equity of Indian company. Now, how do you see this impacting the investments from VCs or FDI players? And also, will it impact the past investments, Sumit?
Right. So I definitely call it a very concerning change in the law, Karishma. This is something which was not to be, because if you look at the memorandum of 2012, when the law was actually first brought to the statute, it was only to cover the unaccounted wealth funneling into the privately held companies through common stock, right? And there was a reason why this law was limited to resident investor alone when it was originally brought. Now bringing it more expansive, including all types of investor, all types of non-resident investor, clearly impacts all VC, private equity, FDI transactions. In a sense, if you link all the fair value rule which currently exists in the Income Tax Act, what this law is going to mean is that unless VC, private equity, or FDI investors are investing exactly at the DCF of the shares, anything paid over and above the DCF value would become subject to 25% tax in the hands of the investing company. That's a significant tax cost to bringing capital to the country, right? And then you'll find it very hard to justify that. So I think it's gonna be a massive one to pull off in the first place. And if the government actually gets past the hurdle of getting it past the parliament, investor will be definitely worried, right? To get each and every investment at the DCF, you are effectively asking all the Indian entrepreneurs to basically give their sweat equity at a lower than the fair value, right? And that's something which will impact many deals, including the
Sure.
including the past, because in the many past deals there are milestones when the equity converts at a given price and at a premium, and then those deals also will be equally impacted.
Right. Okay. So yeah, and let's hope government reviews this because, as you said, it has a far-reaching implication on the FDI. So, also one point, interestingly, that you mentioned, Sumit, was on widening the tax authorities' power to withhold refunds. I personally feel this will adversely affect, honest taxpayers who would prefer to litigate after paying taxes instead of preferring stays. So again, the weight of refunds will increase manifold here, and again, the courts will get overburdened with writs. So this is
Correct.
something which, according to me, is quite scary. And there is a question that has come up that, joint commissioners which have been appointed, whether they will be between the CIT appeals and the AO, it will not, it will be parallel. So basically, the small taxpayers will be able to appeal to the joint commissioner of appeals. And it's not only for individuals or HUS, but it is also for the smaller companies. I think, Sumit, what was announced was, and you can correct me if I'm wrong, that it will be for orders which are passed below the rank of the deputy commissioner will go to the joint commissioner appeals, right? So that parallelly the appeals are getting disposed of.
Correct. And I would expect maybe as the fine print or the detailed rules are set out, there could be some monetary threshold also for the distribution of cases between the historical appellate forum and the new forum. So that is something for us to watch out for.
Sure, sure. No, thanks. So that does round up the direct tax side for us. So Gulzar, over to you on the impact of indirect tax proposals.
Thank you, Karishma. Before I start to unfold the detailed changes proposed in the budget, from an indirect tax standpoint, according to me, the proposals clearly indicate that the government's vision is to discourage import of finished goods and promote their manufacturing into India. And therefore, tariff measures have been used by the government to demonstrate that intent. Secondly, I feel if one wants to import finished goods at a lower rate, then reliance needs to be placed on country-specific free trade agreements to boost the trade between the two participating countries. And finally, government is making efforts towards decriminalizing certain offences made into the tax legislations, of course, which are not of a very severe nature. Now, starting with the changes in Customs Act, very few legislative changes have been made. One change which has been made is under Section 25, where in last budget, government provided that every exemption notification issued, which is conditional, will have a validity period of 2 years. Now, but there has been an amendment which now clarifies that condition will be applicable only to basic customs duties. And of course, in case there are bilateral agreements or multilateral agreement between the countries, there are some foreign trade policy schemes which have a validity period of more than 2 years. There is any central government scheme which is going to provide such benefit for more than 2 year period. In that case, there is this automatic sunset clause will not apply. And in fact, let's say there are some exemptions given under the GST law, typically which impacts the IGST, then also this exemption will not apply, and therefore the restriction is only to basic customs duty. Second legislative amendment is on prescribing time limits for disposal of cases before the Settlement Commission. Currently there is no specific timeline prescribed within which the Settlement Commission has to pass the order. Now, the government has introduced a provision whereby once the application is filed by the taxpayer, within 9 months from the date of last month of filing of this application for Settlement Commission, the application needs to be disposed of. And if that disposal does not take place, then the proceedings instituted by the Settlement Commissioner will abate, and the matter will go back to the original adjudicating authority. However, this provision does not talk about, if the delay has been caused by the taxpayers or the tax authority or the Settlement Commission, how would that impact the entire proceedings? And therefore, I think government may need to look at to provide that if the delay is due to the taxpayer, then of course the 9-month period needs to be seen, and whether the delay was caused by the tax authorities, then is there a way in which the extension can be granted. Now, moving on to the next slide. Some changes in the provisions relating to countervailing duty and anti-dumping duty have been made. I think predominantly, if I have to call out the specific provision, is that government is actually saying that the order of the Director General of Trade Remedies, which is the body which reviews the amount of anti-dumping duty, which reviews the application filed by any of the importer or the exporter, their orders can also be appealed against. And finally, the government does not review or determine the amount of anti-dumping duty. It is the Director General of Trade Remedies which does it, and therefore a government can review it and pass orders not to continue with the duties or to continue with the duties. So this is more of a clarificatory amendment which has a retrospective effect from 1st January 1995. If we move to the next slide. Now, some amendments have been made in the Customs Tariff Act, and typically to align it with various chapters which have been globally passed, and in fact the changes which have been made last year in the Customs Tariff Act also. One notable change is towards the amendment of the definition of project import. Now, Chapter 9801 included power projects which allowed import of goods at a concessional rate if the import is made under a project import scheme. Now the definition of power project has now been amended to exclude any solar power project or solar power plant from the definition of project import benefit. And therefore the concessional benefit of 5% or 7.5%, which was available to all power projects, will now no longer be available to solar power project. This, according to me, should not impact ideally the licenses which were granted by the government already, and the imports are still continuing. But the intent seem to be clearly not allowing import of solar modules and solar cells under the project import scheme. Another notable change is to just clarify and to make sure that the way custom classification is done, there is a consistency with the global classification principles, and therefore the categories, the categorization of products into which proceeds with different group headings and tariff headings. Government clarified that if a product or a group of product has 3 dots, it's very technical, it has 3 dots which is preceded by 2 dots or 1 dots, it will be treated as a sub-categorization or sub-classification of the preceding dots. So with this, I think these were the major changes in the Customs Tariff Act. Now we will talk about the changes in the duty structure. So moving on to the next slide. As I said in the beginning that the tariff measures taken by the government clearly indicates that manufacturing into India should be promoted, and therefore customs duty has been increased on finished products. So if we can see some of the major items, let's say non-essential items, jewelry, that there is an increase in customs duty rate. If we import electric kitchen chimney, the custom duty rate is increased to 15% from 7.5%. Import of bicycle, again, there is an increase of custom duty by 5%. Similarly, toys and part of toys. Again, the custom duty rate is increased by 10%. Which, however, there has been a reduction in the social welfare surcharge, and therefore the net impact is 2 to 3% in totality. In the next slide also, if we see some of the customs duty rates which have been increased. So moving on to the next slide, please. Yeah. Now, if we see the government has introduced PLI scheme, which was for electronic vehicles and vehicles with blended fuels, etc. So to promote the domestic manufacturing and increase more and more value addition, if I'm importing vehicles, including electric vehicles, in semi-knockdown form, then the customs duty on that is increased from 30% to 35%. But with a corresponding reduction in social welfare surcharge, the effective increase is 2%, because currently I'm paying 33% customs duty, but now I'm going to pay 35% customs duty. Similarly, any vehicle that I have imported, I'm importing from outside India, which is completely built, which is a completely built unit, the customs duty rate is increased from 60% to 70%, whether it is EV or it is ICE made vehicle or a diesel engine. Again, effective rate is increased only by 4% because corresponding change has been made in the social welfare surcharge. Moving on to the next slide, there are certain reductions also in the customs duty rate. And if I have to talk about the key ones being, reduction in customs duty rate on camera lens and parts used in manufacture of camera lens for mobile phones. So this is also in line with the production linked incentive scheme announced for manufacturing of mobiles, and therefore import of raw material is encouraged, and of course import of finished product is discouraged. Another is heat coil use in manufacture of electric chimneys. This also clearly indicates that while the customs duty rate on finished product is increased, similarly there is a reduction in the customs duty rate for parts which are used in manufacturing of electrical chimneys. If you go to the next slide, some of the vehicles that now I want to import for the purpose of testing and certification. So this is again to provide boost to local manufacturing and making sure that we also have technology in India. We import finished products. We import completely built unit automobile and automobile components, and therefore if I am going to import them for the purpose of testing and certification, then the custom duty rate has been reduced to nil. And similarly, to promote manufacturing of lithium-ion cell for use in manufacturing of EVs. Any capital goods imported will now be subject to zero customs duty. So these changes in customs duty clearly indicate that the fillip is towards manufacturing into India and discouraging the finished product import. Now moving on to the next slide on customs. There are certain exemptions where the validity has been extended by government to March 2024, and some of them notable changes are batteries for electrical operated vehicles, including 2 and 3 wheel motor vehicles. So this again, exemption has been, the concession has been extended by 1 more year. Similarly, components and parts of engines and aircraft, if they are imported, the exemption was till 31st March 2023. Now it is being extended by 1 more year to 31st March 2024. Now, next slide also talks about some of the similar extensions that are provided, wherein the key one is, if we see again, going on to the promotion of EVs. If I'm importing lithium-ion cell for manufacture of battery or battery pack, whether it is for mobile phone or whether it is for electric vehicles, I will continue to enjoy the exemption up to 31st March 2024. Now, again, for life-saving drugs, the sunset clause is now extended till March 2025, which means that post that expiry of sunset clause, there will not be any concession provided by the government in life-saving drugs and medicines and diagnostic kits. Now, coming on to the next slide. So this slide talks about reduction in social welfare surcharge, and some of the changes, as I mentioned earlier, are linked with the corresponding increase in basic customs duty. And therefore, effectively, wherever this social welfare surcharge is reduced to nil, there has been a corresponding increase in the basic customs duty. So there is some impact for the importer in their customs duty cost. Now moving on to the next slide. Now coming to the GST related provisions. Government has increased or basically enhanced the scope of taxability of OIDAR services, which means that if I'm providing services from online services from outside India and I do not have any presence in India, then I need to take registration and pay tax to the government directly. And the definition has been increased, has been amended to even include imports made by services availed by non-registered person, even for the purpose of businesses. Earlier, if I was receiving those services for my personal use or personal consumption, only then the overseas service provider was liable to take registration into India. But with the proposed amendment, even if a non-registered taxpayer who is using it for business purposes, that will also trigger the liability to take registration for the overseas service provider. For e-commerce operators, as mentioned and approved in the GST Council meeting, now they can also be covered under the composition scheme. Earlier, there was no facility provided to e-commerce, the suppliers who were dealing with e-commerce operators to opt for a composition scheme. This is going to provide a very big relief to all the small suppliers of goods who were trading through the e-commerce platforms. And this has been a demand of the industry for very long. Moving on to the next slide. There has been a retrospective amendment made under Schedule 3, which talks about transactions which not be treated as supply of goods or supply of services. So certain transactions like goods do not come to India, merchant trade transactions, high sea sales, sale from a bonded warehouse, those transactions have now retrospectively, the schedule has been retrospectively amended to provide that those transactions will neither be treated as supply of goods nor supply of services. However, anybody who has paid tax on those transactions will not be eligible for refund. And therefore, this needs to be seen how the industry is going to react to this, because somebody would have already paid tax, and now with the retrospective amendment, how it is going to impact the entire tax that they have paid. Next slide, if we talk about some of the important changes. Some procedural changes have been made with respect to monthly filing of GST returns, annual filing of GST returns. Earlier, there was no sunset clause to disclose or disclose your supplies or to provide or to file your returns. Now, the government has put a sunset clause that after the end of 3 years from the due date of filing of that return, you can neither file the return for your outward supplies, nor you can file GSTR 3B, and nor you can file your annual returns. The intent clearly seems to be making sure that there have been cases where people were issuing invoices even for the transactions made in 2017-18 and 2018-19. Another important and notable change is consent on sharing of information. Now, government has developed, so this new provision actually seeks to enable or provide authority to the government to share the information which is provided to the GST by the taxpayer with other systems or other agencies. Of course, that has to be with the prior approval of the supplier or the recipient. Next slide, if you talk about some relevant provisions. So input tax credit, if I call out the major change, which is now input tax
Gulzar, I think we we can't hear you very well.
I think we lost Gulzar, some technical issue. So while Gulzar is coming back, and since we are on the top of the hour, I think he's covered mostly all of it. Just one quick reaction, Sumit, from you and from Sanjay sir. So, Sumit, according to you, in 30 seconds, if you were to say one big hit or one big miss, what would you say?
Okay, I'll start with the one big miss, Karishma. One is not extending the 5% rate benefit for the long-term infrastructure debt financing. That to me is a huge miss, and that was in line with the government's intention of bringing about $1.3 trillion of the long-term capex for infrastructure growth. There has to be a solid reason as to why this hasn't been done, or is there something that could be done during the year? So we'll have to watch out for. In terms of one big hit, the good thing is that there is no increase in tax rate. There is no surprise in terms of retrospective amendment. So that's to me is a great advantage.
Right. And Sanjay sir, do you think
Gulzar is back. Let's ask him to complete the slides quickly.
Okay, Gulzar, can are you back? We can't hear you, Gulzar.
Hello.
Yeah. Hello.
Yes, am I audible?
Yeah. You're audible. So Gulzar, you have 1 minute to wrap it up because we are on the top of the hour. So please.
Yeah, so I think the last provision is on amendment in the registration requirement. The previous slide. So anybody who was engaged in providing non-taxable supplies, exempt supplies, was even required to take registration if there was a liability to pay tax in the reverse charge. Now, the amended provision actually enables, let's say, companies who are dealing into totally exempt supplies, let's say alcohol companies or let's say power companies, where output is completely exempt. Now, they are not required to take registration just to pay tax under the reverse charge. So this is a big relief, according to me, which was a long pending demand of the industry. Finally, I think 10 seconds on next slide. There has been an increase of by 16% in the rate of NCCD, wherein 16% NCCD has been increased on cigarettes. So I think with this, I will wrap up my indirect tax proposals and amendment, and back to you, Karishma.
Yeah. So Gulzar, just one last point, if you can comment on, which is a question from the participant. that what is the possible objective of the government to introduce a specific provision in GST, regarding exchange of the GSTN with other systems?
So I think government has been developing a lot of business intelligence and fraud analytics tools to identify tax leakages and curb tax evasions. And therefore, this requires exchange of information within several systems as well as government departments. And therefore, an enabling provision has been introduced to ensure that such exchange is not legally challenged in future. And therefore, the provisions also talk about that prior consent of the supplier or recipient needs to be taken before sharing such information with any other system or any other agencies. So I think that's the idea, according to me, behind enabling such provision.
Okay, okay. And before I go to Sanjay sir to just for his concluding remark, while Sumit just when you dropped off mentioned to us one big hit and big miss from a direct tax perspective, from a IDT perspective, what would you say in 30 seconds? One big hit and one big miss.
So I think I was expecting the dispute resolution scheme for customs as well. Government has collected over 38,000 crore in the last dispute resolution scheme for excise and service tax, and industry has been demanding for it. And therefore, we are also expecting some such similar scheme to come under the Customs Act. And another is announcement of additional PLI schemes. In addition to 14 sectors which were covered by the government, we were also hoping that 3 to 4 additional sectors will be covered to provide boost to the again Indian manufacturing Atmanirbhar Bharat mission.
Right. Okay. So as we say, dil mange more always. Government can do only as much as we can. Sanjay sir, so do you think the government has done enough to ensure a good sustainable economic growth?
I think so. Of course, there is a lot more that the government can do. I mean, as you said, dil mange more. But there are few pointers which do tell us that it's on the right path within a limited distance. At the moment, the government is concentrating a lot on the infrastructure development, physical as well as digital, and that would augur well for the country as such. It has also paid a lot of attention, and as we heard Gulzar talking about a number of rationalization of customs duty. So they are looking towards increasing the size of manufacturing, because the services sector in any case is growing at a good pace, 9 to 10%, which is a healthy growth. So why not also start talking about manufacturing? And on that they have done some rationalization of the customs duty, because they want the producers to set up the shops in India rather than import it from outside, the goods particularly. So duty inversion, which has been a major problem on the customs side, and it has happened over a period of time. There is a time to correct that, and some bit of correction has happened. So while we are talking about all these things, the government has also paid a lot of attention to the social sector. We talk with on the health also. They talked about a few things such as increasing the number of nursing colleges, because that they are the foot soldiers on health. So while one can read and decipher many of those things, but overall glide path is for a sustainable and resilient economy.
Okay, thanks. I think that's quite encouraging, and I think the experts have really summarized the impact of the proposals very well. So while we did try to answer, most of the questions, if something remains unaddressed, we will email to you the answers in a couple of days. We'll encourage you to please fill out a short survey that will pop up on your screen momentarily and tell us what you think about today's program. In case you've joined late, then please note that the presentations will be archived for future viewing. So if you feel that others would like to benefit from this, then please share the webcast via the share this icon, or you can have them visit the debrief website. And so while you all are filling out the survey, I would like to conclude by saying that the last full budget, I would say, of the Modi government is an inclusive budget. I think it provides wings to the India's growth story, and it is a step in the right direction to make India one of the top economies of the world. And ultimately, it will help in achieving our dream of becoming a $5 trillion economy. So, in my view, the budget 2023 has focused on all sections of the society, and it does lay out a strong foundation for a new and a future India. So, on this positive note, I would like to thank Sanjay sir, Sumit, and Gulzar for sharing the detailed insights. And also, please don't forget to tune in to our next scheduled webcast, which is from the transfer pricing series, which is on February 9th, which is titled Developing an Operational Transfer Pricing Framework, the Practical Implications, an interesting one personally from my end as well. At last, from all of us at Deloitte, a very special thank you for your participation in Deloitte's APAC TAC webcast today. And thank you, everyone, and have a good day.